Hello, and welcome to MPA Financial Team tutorial number 3, where we're going to be looking at the charts and indicators. This is the third of a series of tutorials aimed for internship applicants in our financial team. You can write to us academy at mercurypartners.net or visit our website. So, if we look at how we work in our financial team with students and junior financial analysts, we have introduced before financial markets and asset classes. We'll look at the equity structures and the GICS classification. And now we're looking at what we use when we look at stocks in terms of charts and some key indicators. This is not a technical analysis tutorial. We have a dedicated analysis in our website with an expert, with a technical analyst. This is just a broad overview on key concepts that we use for you to be aware of it. When we look at equity charts, a stock chart is obviously a visual representation of a stock share price and trading activity over a time period. It displays how the price of a stock has moved up or down and can also include other variables such as trading volume and technical indicators like moving averages, RSI, or other oscillators and patterns. The first thing that we teach myself and the portfolio managers to the financial juniors is when you look at a stock and you start doing research, always have a time approach. Start from a long-term chart. Long-term chart can tell you a lot. And generally speaking, to us, long-term means 10 years or more. This approach focuses on identifying major structural trends such as secular bull or bear market. It is less affected by short-term noise and more aligned with the economic cycle and investor sentiment shifts, and it's used for strategic decision which capture large sustained moves. As I said, 10 years or even sometimes 20 years charts, that's our starting point from a long-term analysis. Then we narrow it down once we have an overview of what has happened to the medium term, which is a holding period, intermediate in nature. Again, here to make it simple, we'll look at a time horizon of 5 years. You already have a good idea what has happened in the long term. We just want to narrow it down to 5 years, which capture intermediate market cycles. And then we move to what we call short term. We are stock picker and investment managers, and we're not daily traders, so we're not looking at hourly candles of trade. So for us, short term means from a year below, but after having looked at long term and medium term, let's say a year chart typically give us enough details. Of course, if there are some significant events over the last few months, we narrow it down, but basically we look at 1 year. So this gives you a very good overview of what has happened to the share price and so the business. Those are just examples. We use Coifin as a platform. There are many platforms out there. You got a free basis version of Coifin. We pay for it, but we have more tools available. But there are many free charts and templates you can use. So those are just some example of long-term, 10 years, mid-terms, and short-term. And we have included just share price evolution with volume at the bottom. Now, it's also interesting when you look at price to know what the difference is between logarithmic and linear price scale. The first one, logarithmic, also referred to as log, represent price spacing on the vertical or y-axis dependent on the percentage of change on the underlying asset price. Whereas linear price also deferred as arithmetic represent a price using equidistant spacing between the designated prices. Linear chart displays absolute value. The key difference between the two is that the linear scale increases by equal amounts, meaning that each step represents the same absolute change, 1, 2, 3, 4, and it is ideal when values grow steadily and uniformly. A logarithmic scale increases by equal ratios, so each step represents a consistent percentage or multiplicative change, and it is used more when the data span several orders of magnitude or grows exponentially. So you can use linear to show absolute changes or log to highlight relative or percentage changes and compress large values. If we look at logarithmic scales versus linear, you have an example again of Apple. We just put the two so you can have an idea. Clearly, they are similar in nature, but I just gave you the benefit and advantage and when to use one or the other. Now we go into moving averages. Again, this is not a technical analysis seminar. We have a dedicated expert on our website to this, but it is important that you know what moving averages are. And those are technical indicators that calculate the average price of a security over a specified period. And these can help you smooth out noisy price fluctuations. They help to identify trends, bullish, bearish, sideways, and they're used by analysts and traders and investors to make strategic decisions. They are an additional tool and they're applicable to different financial assets, stocks, forex, raw materials. So you can use them not just for stocks, but for all main financial instruments. Looking at moving averages, again, it depends on what time horizon, investment goals are. We typically look in Mercury Partners at three main moving averages: 20-day, looking at what we call short term, 50-day for the medium term, and 200-day for the long term. The 20-day represents short-term trends. They're useful for day traders or swing traders, and they follow the price closely, and you have quicker signals. The 50-day moving averages represent an intermediate vision of the market. Is very used by investors to confirm some trends and often used to identify some trend reversals. And the 200-day moving average long term considered the key average for the long-term trends. It helps determine the overall health of the market or the stock. And if the price is above the 200-day, the market is bullish. This is a very general definition, but basically above or below gives a sense of where the trend is, how it is going. If it is below, it is considered more bearish. Again, this is in general terms. There are many other caveats, but just for you to have an idea. You can see in a stock here the three moving averages, and what is important is also the crossing and the relationship between these lines. Before we go into this, it's important for you to know there are two main types of moving averages. We just focus on the simple moving average and exponential moving average, SMA and EMA. And if we look at the definition, basically the SMA is an arithmetic average, whereas the EMA weighs more recent data. So if we take a 50 days moving average, the SMA will give the same weight to the past 50 days. So the first day counts as the last, as it is an arithmetic average. In the EMA moving average, exponential moving average, the days closer to the present have a higher weight. So in terms of reaction speed, the simple moving average will be more slow because it gives equal weights to the time period, whereas the EMA would be more fast. Obviously, you have pros and cons. One is more reactive, the other is more stable. And this is just an example. In terms of relationship between the moving averages, most common uses, again, we have a dedicated technical analyst with video tutorial, but a very much used indicator is the golden cross, which is the 50-day moving average breaks and goes up above the 20-day. This is considered a bullish signal. The dead cross is when the 50-day falls below the 200-day. is considered to be a bearish signal, and all the other crossover events. Again, these are just tools which are very much used, but always have an overview picture of the market, of the sectors, of the stock belonging to the sector, and those are additional tools which are important to determine, in addition with the fundamental analysis, what could happen to the share price. You can see an example here of a golden cross. The 50-day moving average is going above and crossing above the 200 days, considered to be a bullish signal. You can see the share price in terms of candle has gone up. And this is a so-called dead cross. The 50-day moving averages have crossed below the 200-day, and then the share price went down. So moving averages help identify trends and filter market noise. The SMA simple moving average is more stable. The MPA is more reactive. The key moving averages in terms of at least what we use and what the overall market tend to use is 20, 50, and 200-day, and they used to analyze markets at different time scales. And the crossovers among the moving averages are key signal for traders and investors. Another indicator that we use, again, there are many indicators, none of them is perfect, none of them can be used individually. There is a whole level and landscape of technical indicators. Relative strength index is one of the most used, and that's also what we use. What is it? If we look at the formula, so the RSI is 100 minus 100 divided 1 plus the average gain and the average loss in terms of days. So RSI moves between 0 and 100, and it uses a positive value for the average loss. Average gain and loss is the average percentage of gain loss during a look back period. Usually it is 14 days, the default. Example, the market closed higher 7 out of 14 days with an average gain of 1%, and the remaining days with a loss of minus 0.8%. What is important apart from the formula and the definition? There is a consensus that if you look at the RSI level, which is the below part of the picture, the RSI will rise and the number of size of up days increase. It will fall as the number and size of down days increase. There are two levels which are 70 and 30. There is a general consensus that above 70, we start to go into overbought territory. So there is no certainty, but the future share price could potentially take a breather and maybe invert. And there is a general consensus that the oversold territory below 30 level, we could start looking at the stock that could reverse this trend. Again, do not look just at this in isolation. This is not a rule that applies all the time, but this is a consensus which gives you an indication where we are. Because the indicator can stay in those regions for extended periods of time where there is a strong uptrend or downtrend, it is better to use signals also in a different way, as I just said. A bullish signal is when the RSI crosses below 30, but it's not so useful because of the downtrend. The entry signal buy is when the security is back over 30. So there is a general level of different indicators which are used in conjunction. I'll show you another one, but at this point for you it's important to know what the RSI is, how it works, and the different level of 30 and 70. Another indicator we use in conjunction with the RSI, it's Bollinger Bands. So we tend to use moving averages, RSI, Bollinger Bands as some indication where we are in the stock cycle or market cycle. Bollinger Bands is a popular tool among investors and traders, and they help gauge the volatility of stocks and other securities. They were developed in the 80s by the analyst John Bollinger, and the bands appear on stock charts as three lines that move with the price. The center line is the stock price 20-day simple moving average. The upper and lower bands are set at a certain number of standard deviations, which are typically two standard deviations, above and below the middle line. It is interesting to see that the bands will widen when a stock's share price becomes more volatile, and they contract, they become narrower when it is more stable. Many traders see stocks as overbought as their price nears the upper band and oversold as they approach the lower band, signaling opportunities time to trade. You can see in these slides as the Bollinger Bands expands or they get narrower, as I told you, depends on volatility. And you can see basically the compression. When the price touches the upper band, it may indicate an overbought condition, as I just said, and the lower band may indicate an oversold. What is important are two concepts. Number one, there is no perfect technical indicators, and usually no single indicator will work. It is useful to understand what indicators are telling you, where they tend to work more, and most importantly, understand what they're telling you and use them in pair or trees. We use, as I said, RSI, moving averages, and Bollinger Bands. Those are also the most widely used pairs in trading. They look at trend direction via moving averages or Bollinger Bands and momentum shifts overbought oversold via RSI. It is important to consider that this is a toolbox. So those are just indicators to understand and use in conjunction with fundamental analysis. You can see some example looks for RSI divergence near the outer band to spot potential reversal or continuation. So again, we have an entire masterclass in investment management on our website. You can write to us at academy@mercurypartners.net if you want to do an internship with us, working with our portfolio managers. We can follow us on our social media, which is this link, mercurypartners.net contact. That's all from me, Marcello Zanardo, CEO founder of Mercury Partners Academy. Hope to see you soon. Bye-bye.